Hi, everyone. A very warm welcome to our third day of the Africa Fintech Summit. And I'm very much happy to moderating this panel, accelerating investment via digitizing due diligence. And we have able and special subject matter experts who will be guiding us through this discussion. But before we start, I just want to relate a famous quote by Julius Caesar. I came, I saw, and I conquered. I'm sure we all heard it. In a perfect world, that is what investors want to. They want to come because investment is de-risked. They see investment because it's visible, verifiable, and trustable, and then they invest. But in Africa, we see a lot of narratives and stories. Local startups say that investors are not coming because of the risk appetite. Investors are saying that there is no enough pipeline of investments. And those who came to the continent are saying that the cost of doing business and doing due diligence is too high, especially for small ticket sizes. Is it real, perceived? Is it being addressed or is it already being addressed? So we have panelists, Lanre from Orbit, Rob from Asoko, and Jakob from Parity. So to get started, I would like to ask our panelists to introduce themselves in their company and also what problems they are trying to resolve in Africa. So I will start with Lanre, please.
Thanks, Chris, and good afternoon, morning, or evening, everyone. My name is Landry, and I'm co-founder at Orbit. And Orbit, we are a trade and investment platform, helping lenders and investors in Africa get matched to opportunities across the continent.
Thank you very much, Nana. Rob, please.
Thanks, Gadias. Hi, everybody. Rob Withigan, CEO, co-founder of Asoko Insight. We collect, verify, and deliver data sets on corporates right across the African continent. We do that through a combination of analysts, which we have right across the countries, right across the continent, covering about 30 countries, technology and local partnerships, working with corporates, investors, and governments around the world.
Thank you very much, Rob. Jakob, please.
Hi, everyone. My name is Jakob. I'm the CEO and co-founder of Parity. We are building an operating system for venture investing and ecosystem building. What that means is we connect capital allocators with investment opportunities and founders with talent so that they're investment ready. Hopefully, we'll be able to shorten the capital allocation cycle from over 12 months as it is right now to maybe closer to 3. So that's our mission right now. Thank you.
Thank you very much. To our audience, we also have a question and answer session. So if you have any questions throughout the panel, just drop the question on the space on your right side, and we'll pick it up at the end of our conversation. So to get started, I have one question. So some of the narratives that we hear, and I quote, there are too many buyers chasing too few opportunities. And one big P firm said that it closed its Africa unit because it couldn't find enough deal pipeline of transaction above $100 million. When it comes to tech, it's a high risk. The higher the risk, the higher the reward. But most of the risk in Africa are different to investment. And how do I know that these guys are legit and they don't run away with my money? So we have those narratives. No enough pipeline of deals, and for smaller ticket size, unjustifiable due diligence cost. Is this investor sentiment justifiable, realistic, or in it's changing, or is it already changing? Can we have your thought? Maybe we can start with Lanra, please.
Yeah, thanks for that, Zacharias. One of the things that sort of often amazes me about the narrative, and even much more so the conversations within the African investment ecosystem, is often the siloed perspectives that are taken, and oftentimes these siloed perspectives then become norms, and then everyone thinks the norm is data, right? And we've seen proof to the alternative of this, that it's not always the case. So what does that mean? What it means is, look, yes, the cost of transacting across the continent it's high, and the cost of origination is high. And it's not necessarily the case that, as you mentioned, one of the funds you just mentioned, you turn up on the continent and you try to write, $50 million, $100 million checks for PE transactions. You don't find those opportunities sat there like you would in, I don't know, Midwestern USA or other parts of developed markets. But it's not to say that there aren't opportunities, or it's not to say that there are not companies that are able to absorb reasonable amount of capital or who are investor ready. The challenge is, what is the cost of finding these opportunities? So, you take a typical PE fund user journey, right? What do? You have an office in London, in New York, you parachute into Nairobi, Lagos, Johannesburg for 2-3 weeks, meet a couple of investment bank guys, and then we try and originate transactions. But it's not always the case that, the companies that can absorb this capital are all sat in the capital cities, right? So how do you find these opportunities that are spread in potentially further away, cities? How do you find the companies that are a better fit for your mandate? How do you find companies that are a better fit for your investment type or size? And I think, one of the things I'm sure we'll talk about is how technology can address this challenge. So that's on the origination side. Now, the other bit of the conversation within the African investment ecosystem that I also just find quite perplexing sometimes is the fact that whenever we have a conversation about investment, there is always almost a de facto assumption that PE is the only type of capital available for companies, right? You take any company's balance sheet, right? There are different tiers of capital that a company can absorb. And this ranges from, raising PE money, raising debt, or raising trade finance, right? So there's an investment ecosystem mix that is often neglected in terms of what it means for a company to raise capital. And I'm sure we can get into that a bit more later on.
Thank you very much, Nando. Very much appreciated. Ro, over to you.
I think Laura has been quite comprehensive. I can really only second a couple of points that we've observed. I think those that claim that there aren't enough deals out there are either coming in with a focus on ticket sizes that are just not fitting the volume of deals that offer opportunity across the continent, or are simply not in a position to identify the opportunities. I mean, obviously we're talking about private markets, and in many ways we're talking about rather opaque markets. The fund-seeking companies are not easy to spot. Certainly not for an investor who may have their genesis, their core of operations outside of the continent. So that comes into what solutions are out there in order to find those companies, right? In addition to just good old personal relationships. And I think as an investor, other than amending the ticket size to an area where it actually fits the maturity and the funding needs of African corporates, it's critical that you have that knowledge of local markets and the networks within those local markets to pick up on the right deals. And to Lamre's point, there are digital solutions out there that can help you with that. I think the people on this call would all agree. But I think, that's the core part of the somewhat negativity around the dominant narrative, but also part of the solution and the opportunity that we're here to address.
Thank you very much, Rob. Very much appreciated. Iago, what is your 2 cents?
Yeah, I'll keep it brief because I think Rob and Lanre did a good job of, sorry about the wind, did a good job of just kind of walking that through. The only thing I would add is this, when you're looking at the earlier stage investments, I think that the problem is you can't have the Western mindset of how you're trying to kind of transplant that investment process here. And I think for a lot of the PE shops, if they're going to look at even going more upstream, it'll probably be more advantageous for them to look at M&A than it would be to think that some of their investment approach would make more sense. Because you're starting to see now, startups that are getting into the 50, 60, $100 million valuations, and they're not really able to get past the hurdle of like getting across the continent. So I think like that will be an interesting opportunity for a lot more funds that are at bigger sizes.
Thank you very much, Jacob. And one of the problem of digitization is you be able to work in the beach and hence the sound. Thank you very much for your insights. So let's just drill down to tech. And obviously, one of the news that has been positive news from tech investment point of view recently is Paystack's acquisition by Stripe. It's obviously a success story. A company that has been operational for less than 5 years, attracted only less than $12 million of external investment, being acquired with north of $200 million investment. But if you go back to their first external investors, Y Combinator not typically invest $120,000 for a 7% equity. So if you take that calculation, after 5 years when they exited, that $120,000 has returned $12 million, just basic calculation. But at the time, Paystack's revenue was just 1,300 per year. So granted, Y Combinator has a different risk appetite, but what do you think investors can learn about investing in early stage fintech and tech startups in Africa from Paystack, and also from Y Combinator's risk appetite point of view, and also local investors who typically invest in brick and mortar businesses? What do you think is the lesson from this particular transaction? Let's go alphabetically again. Lanre, please.
I mean, yeah, obviously the Paystack story is a great one and is a good success story. What can investors learn? I mean, to be honest, I think there's also the tempering of expectations on all sides that needs to be factored into the way investors approach the continent, right? Because if you're an investor looking at a fintech startup, and I think Jacob probably speak more to this from a fintech startup point of view, and expecting to come in and have a return in 4 or 5 years and get out. Yes, you might find opportunities like that, but I think as all of us know, having sort of been working across the continent, it's not always the case that things happen as quickly as that, or they happen in exactly the same sort of formulaic approach. So that's one of the note of caution. Having said that, it's a no-brainer, and I think all of us, across the continent and those listening will sort of agree that, the opportunities in terms of growth opportunities across the continent is very encouraging. So we use ourselves as an example, in terms of our platform. We see the growth rate in terms of number of companies coming onto the platform looking to raise capital, the adoption of technology across the continent. It's just the fact that, a lot of technological solutions are being applied to various aspects of the economy and across the continent, and this sort of gives rise to sort of interesting multiples, both in terms of growth multiples and potential investment return multiples. But things don't happen overnight, and I'm not going to sit down here and say, all companies or all fintech companies or technology companies across the continent are going to return exactly the same or in the same time as Y Combinator has. So that's just my own 2 cents on that one.
Thank you very much, Lanre. Rob.
Yeah. Thanks, Zakarias. So I mean, I think looking at what investors can, there's a lot of things to learn from the Paystack success story, which it really is, and it should be acknowledged as such, and it goes far beyond the relevance for Paystack's founders and investors. It's an important acknowledgement for the African VC tech space across the board. And I think it's important to all take note of that. I think one of the big issues VC investors continue to have with African tech is the limited exit opportunities. This is showing that trade sale is a very available live option for exits, and hopefully it's doing the ecosystem a lot of good. So that's perhaps one takeaway from the standpoint of the transaction with Stripe. From Y Combinator's perspective, I think I think what's interesting here is that Paystack, which is a B2B play, right, is showing that there's a tremendous investment opportunity in B2B. I think a lot of the tech investment hype has been around B2C across Africa, in particular around e-commerce. Somewhat with now challenging and skeptical conclusions, looking at some examples that may or may not have lived up to their promise. I think Paystack is showing that in the B2B space there's a tremendous potential as well, if not bigger than in B2C, which is a good takeaway, right? Perhaps one of the more challenging ones is that, according to your back of envelope calculations, Zakaria's Y Combinator has secured a 100x multiple in 5 years. I think one thing that we always caution newcoming investors to Africa is not to expect every deal to result into 100x in 5 years. So from that perspective, Paystack makes building a realistic picture in newly incoming investors' minds a little bit harder. Well done to them, but I do want to caution it with saying, there are particularities to operating challenges around Africa and building a Pan-African business that is likely to lead to longer investment cycles and potentially somewhat more modest investment returns. Still very good ones, but just not triple digits. And I would just want to caution that, hopefully we're going to see many more Paystacks, but also those investment opportunities that deliver less than a Paystack return still is a very good one. I think I'll end it there.
Thank you very much, Rob. Before I invite Jacob, let me just add additional question to you, Rob. I mean, there is a reason I mentioned the revenue for Paystack was 1,300, but I know was for all three of you, one of the first question investor will ask you is that what is the revenue estimate of companies? And when that information is not available, you do all sort of AI-based analysis and estimation of revenues. Obviously, from investors' point of view, revenue actual is important, but from this example, we see projected revenue and knowing the addressable markets maybe even more important. Any point, Rob, and also Landra as well, you can add to that point.
Yeah,
I'm sure this is one question constantly being asked from your platform and give estimated revenue. Any comment on this?
Yeah, I think I'll just jump in real quick, Rob. And one of the things that, just to kind of contextualize this conversation, is so there is the companies that come to our platform to raise money. So, for example, for us at Orbit, we deal with the traditional companies who are looking to raise, trade finance and PE money, and these are the old businesses. But of course, we ourselves are a fintech startup, right? So there is that, sort of just to separate that. Now, sticking with that line of thought and your question is the fact that one of the things you get, and I'm sure, Rob, I think we've bantered about this a few times, you get VCs or potential VCs or investors in Africa, tech companies coming to you and asking you, show me a path to $100 million recurring revenue. Whilst it's definitely an important question, but I just find it quite redundant sometimes, right? Because show me how many companies across the continent turn over $100 million, even the companies that have been on the continent forever, right? So the point I'm trying to make here is, as a fintech or startup, right, what you're doing is you're solving a problem. And by solving that problem, you are providing a reduced cost of transaction within that particular space. Now, tying into what Rob mentioned, it's not always the case that, that problem you're solving is large enough to go IPO, right? I mean, how many fintech startups or technology startups in Africa have we seen go IPO? So more often than not is a trade sale. So the more logical question then sort of lends itself to being like, okay, well, the problem you're solving, right, who is a potential acquirer for this and what value does that create or could that potentially create for such acquirers? And I think that with that thought process, we can then have a more sensible conversation in terms of fundraise, in terms of investment opportunities, and in terms of alignment of interest between a VC and a tech startup in Africa. So, as Jacob already mentioned, if you're coming with a West Coast philosophy of, show me $100 million, part $100 million revenue, I'm going to IPO this NASDAQ, I think you might be in the wrong business. Or on the wrong continent, I should say.
Yeah, I think some great points there, Lanre. I mean, just to add to that, I think first of all, I absolutely agree. I mean, the sole focus on revenue is a misguided one. I think that the tech space in Africa is in a nascent stage, and what we're building, all of us on the line here, what we're building are foundation businesses that can morph into many other businesses, right? So the value of data, the value of IP, of technology, the value of a client network, the value of a brand should all be factors that feed into the valuation, rather than just the revenue of what happens to be currently the business model that drives that business through its first stage. And it takes a particular investor to see with that. For those on the call raising investment, we've felt that pain firsthand, and it takes a couple of conversations to land that first investor that sees it that way. But I think it is important that startups become better and wiser at telling that story to a growing investor base, and really take responsibility for somewhat educating a newly incoming Africa investor to see it that way, which is not an easy part, but I think that's the only way it can be done. On the other side, and perhaps something that makes it more challenging is the listing of Jumia, for example, which has brought a lot of question marks around their supposed profitability and their supposed sustainability of the business model, together with big global blowups like WeWork in their pre-IPO stage, has made the need for profitability and has increased the emphasis on revenue in the minds of pretty much every investor around the world, including those looking at Africa. So the challenge that fundraising African startups are in has in some ways only become bigger because of those very visible examples putting more weight towards the profitability line on a P&L. So yeah, we've got our work cut out for ourselves.
Thank you very much. Great points there. Thank you very much, Nandra and Rob. Yeah, Rob, any additional points on that?
Yeah, I have a few. I would say the additional point that I would add about the revenue thing is when you're looking at a startup, judging it on its current revenue would probably be the worst decision to make, right? Like you're already speaking the wrong language at that point. But it's more about the potential and seeing what the opportunity looks like. If you think about Africa right now, you could almost compare it to the Industrial Revolution in the States, where there is a blank slate and there's also not a lot of legacy that you have to recorrect or fix. There isn't the JP Morgan of Africa yet. There aren't the Carnegie Mellons. There aren't all those things are being built right now. But then when you look at the acceleration of the ecosystem, the Paysac exit would be a great example. That was 5 years, and you had a $200 million exit, right? When you think about that with FX as well as inflation comparisons, how fast did it take other tech ecosystems to be able to reach that level of an exit, right? The acceleration of that is like almost looking at the African ecosystem in dog years. So those would be the only 2 points that I would bring out that would add to what Rob and Lanre have said so far.
Very much appreciated. And earlier on, you just brought good points about visibility of opportunities. Most of non-continental based investors send their deal sourcing professionals to big cities, and Lanre mentioned, and scout for opportunities, and there is no local connection. That is a prerequisite in Africa, as Rob has brought out. And analysts have this word called laziness premium, in which investors don't have the right connections, the right tools, the right local knowledge to verify investability of a local startup. So they just add a laziness premium for the unknown risk, the unknown, so to speak. So from point of view, how do you think digitizing the opportunity and also digitizing the KYC, ML, and DD is helping accelerating investment de-risking, in particular, maybe Landra and Rob, if you can address that?
Shall I go first, Robert?
Yeah, go for it, Rob.
All right, thanks. I mean, there's a lot to unpack here, and I'm sure Lauren's got some good points. So I'll keep mine limited to just the 2 or 3 top ones that come to mind. I think one is it's a matter of cost. We earlier spoke about the KKRs of the world withdrawing from Africa because they come in with big ticket sizes, and they find limited economic viability in smaller ticket sizes. That's mostly because doing DD in a traditional sense is very expensive, and therefore forces investors to look at a minimum ticket size to make enough money. Essentially, that's how it works, right? So the ability for digitized access to data reduces the cost of origination, first of all, and due diligence, secondly, and therefore allows for smaller deals to become economically viable for investors. And we're talking private equity, private debt. I just want to classify the specific nuance of investment classes we're talking about, right? So I think it just lowers the bar for fund seeking companies to get on the radar of an institutional investor. I think that's one. The second point I would make is digitization is a tremendous opportunity, especially in Africa, where it can really make an impact. Because as in so many other areas where digitization is making an impact, it particularly is in deal origination and deal due diligence, because the alternative is so inefficient. So it can really bring deal making on the continent far. We shouldn't, however, look at it as a completely substituting way of doing deals, right? I don't think there's a substitute for any private equity investor to sit down with the individual or group of individuals they're about to invest $25 million in. Like there's no alternative for that. A digitized platform is not going to build for a better experience than that, right? It helps everything around that critical in-person encounter to be done much quicker and at much lower cost, for the simple mathematics of not having to fly into Lagos and pay a Lagosian hotel rate, which is ridiculously expensive, as we all know, and sacrifice 5 days, a lot of it stuck in traffic, to sit down with one company. That time can be allocated a lot more efficiently and effectively, and I think so the contextual costs can be saved. But it's important not to look at this as this single solution, this silver bullet that's gonna dramatically change the way deal making is being done. I see it as an efficiency driver, not as a substituting way of doing business or doing deals. I'll stop there.
No, absolutely. I totally agree with you, Rob, and that remains that remains true across the continent. I think the only thing I would sort of add to that is that just the way you've rightly classified in terms of the asset classes. The private equity asset class is a different animal to other asset classes on the continent, right? So if you think about asset classes such as the debt asset class, and I'm sure Jakob potentially talk about the venture capital, and I can speak to the trade finance. The emphasis that is placed on the sort of pressing of the flesh, as we like to call it, is totally different. It's totally different within, other asset classes to the private equity asset class. And what does that mean? That means that certain elements or more elements within those asset classes and the transaction within those asset classes lend themselves to digitization. So, what's the typical example I would use? You can go and press the flesh of your bank manager down the street, on your high street as much as you like. If your credit score is rubbish, you're not going to get a loan. It's as simple as that. You're not going to get a loan, right? You're not going to get a mortgage, and it's as simple as that. So yes, correct, Rob. In terms of the private equity and the nuances within that, and what elements of that lends itself to digitization, which is particularly around the origination, the discovery, potentially the analysis, and even things like comparables and all of that stuff. But other asset classes, lend themselves to different type of or to further digitization compared to the PE. So if you are thinking about investing in Africa or investing in companies in Africa, then those are some of the things to put in mind. But I'm sure Jakob can speak to the venture capital end of the spectrum.
Yeah, so I think like at the stage that you guys are supporting for the investment cycle, it has that critical need. But as Rob, as you said, you can digitize certain things to make the decision get faster, but you do need to meet the team. There is a really critical, important part about that. For Parity, when we're trying to help venture capitalists make these informed decisions, these companies just don't have that much information. So you don't need a 12-month life cycle for you to be doing DD on a company. If we're sourcing the information, we're vetting the financial model, we're reviewing the product, we're making sure that the actual throughput of the product reflects what the financial model is projecting, you're able to make a very quick decision. Do I want to learn more about this and actually spend time with the founders and like really understand what's driving them, right? So on our platform, we've seen that investors are able to make a decision in less than 30 minutes based on the vetted information that if they want to move forward with a founder, which is extremely critical because founders' times are limited. I mean, Rob, Lanre, we all do not have time. Like every day we end it saying, I wish I had a couple more hours. So for an investor to be able to really know if they want to move forward with the founder is extremely healthy for the ecosystem is how we look at it. And also because of the asymmetry of the information on the continent, it's also why the company's name is called Parity, is that we try to help you find the right deals faster. So we've seen for the funds that are on our platform on aggregate level information right now, we're seeing connectivity with deals that Parity sources through our algorithm and their investment criteria to be upwards of 83%, whereas their own general pipeline being less than 15%. And that is just because the way our network is set up and the amount of experts that we have on top of our AI allows us to really be more informed about it. It's not about just getting to the yes as fast as possible. This is getting to the decision as fast as possible. No one needs a maybe. We want investors to be able to say yes or no quickly so founders can move on and be able to focus on their business. So that's how we see the digitization of due diligence actually affecting the ecosystem. So,
actually, just to add to that, actually, Jakob, that's interesting because ours is actually 80% in terms of the investors or lenders connecting to companies and engaging and the decision to move forward. So that's quite interesting. It's within the same ballpark.
I mean, sorry, I was on mute. I think, Lana, we can talk a little bit further. I think we'll have some data that we can cross-reference as our companies are going to graduate more into your world. So, but that's good. That's good information and insight to have.
Good. Thank you very much. And I really appreciate your humble views of what digitization can do. But see it as a critical element of investment drive to Africa. On the first day of our FinTech Summit, our keynote speaker was TDB's Vice President and President and CEO, Mr. Tadesse. And how digitization is affecting not only the private space, but also even the DeFi. He related an experience of TDB using blockchain technology in closing trade finance that would have taken months has been closed within 2 hours. Obviously, the credit risk and everything has to be done, but just closing within COVID environment, a trade finance deal within 2 hours, it could be a life and death for several African companies. So I think your platforms are doing great to the continent. But related to what you're doing, there's also a question about local talent. For example, you have an investor based in Europe or America. And when you do an investment, there is associated due diligence related value chain suppliers, like lawyers, you have financial advisors, you have the financial modeling, checking that the document, the registration is legit, valid, recent, updated. So the due diligence cost, if investors are using their traditional value system based in their own ecosystem, one, there is miscommunication. B, there is a lack of local understanding. So how is your platform helping from that point of view? Maybe let's start from Jakob and then we go to Rob and Lanra.
Yeah, it's a great question. Actually, this is the basis of our platform. Originally, we started off just thinking about how do you allow founders and investors to have access to talent and capital on the continent, and the talent side is extremely critical to make sure that it's localized. If someone doesn't understand the region, then your comps or your approach to anything you do is just going to be very skewed. So a perfect example is that we have a Chinese fund that is on our platform, and they'd actually have made an investment on the continent. And through our platform, we do vet these companies, and the people that are vetting them are not only of the continent, but have had global experience. So if the deal is a Nigerian early stage startup that's having some attractive traction with it, we would be able to staff someone that's from Lagos that maybe went to HBS and then worked at McKinsey and came back. So they've seen global scale. They understand how to kind of get into the nitty gritty of things, and they speak the multiple languages. And I think that's one of the most critical things, is to be able to speak that language, to be able to code switch and be able to have different mediums, which allows investors that don't understand something to get comfortable. The concept of speaking the same language is one of the biggest things to get people to be able to have trust in an investment, and localizing that talent, but actually having global perspective is one of the best ways to accelerate that due diligence. In the same way that you look at an Uber or an Airbnb, we are disintegrating the talent from the asset. So you're not hiring this person full time as a fund to be your analyst. What you're doing is you're running them for their specific skill. And on the other side, that person gets to monetize their skill, right? COVID has accelerated that tremendously for us. So I think at this point, we're no longer having to defend our model. It's more so, can we service the need for it? But that I'll stop there, and I'll keep it open for Rob and Lanre.
Yeah, no, that's a great segue, because again, just as you've described, the way you're just aggregating talent and opportunities within the VC space. If we then go up one deck to sort of corporate in our world, right? So what you find is you have investors and lenders looking to do transactions across the continent. And again, just one little caveat to put here. We keep using this term investors, and almost always as this underlining tone of foreign investors coming into Africa. You have capital moving within the continent as well. So you have PE funds based in Johannesburg doing deals in Nigeria, guys in Nigeria doing deals. So there's that whole sort of capital movement within the continent, which still has the same challenges, right? So just as I was saying, you have a fund that, for example, on our platform based in Tunis, funds an opportunity in Tanzania through our platform, but then they need to do their due diligence. Now, of course, COVID has accelerated, as Jacob has said, but how do you find a legal advisor that can help you do due diligence in Tanzania? How do you find someone that can, check the warehouse to make sure that the goods are exactly what they said they are for the trade finance transaction? How to do all of that stuff. So again, on our platform, we've essentially created this financial services marketplace whereby you can now access, corporate finance advisors, lawyers, insurance providers, all of the various ancillary services that you would need as part of the transaction, and be able to sort of access those digitally and to execute your transaction in a speedy fashion.
Thank you very much, Nara. Rob, do you want to add something? Or
I think both gentlemen have covered things comprehensively. I mean, yeah, it's a little bit of a no-brainer from my view. Like the alternative is just so inefficient. The alternative of having to find and verify and build a relationship with a lawyer and an accountant and a data analyst in pretty much every country across the continent where you want to make deals is just such a challenge. And that's the way it's still being done today, right? Outside of the platforms that we're running, that's how people go about running the investment cycle. So I think it's a matter of time before the digitized solutions move from the category new, interesting to like this is the norm. We would be remiss to our shareholders if we wouldn't be doing this. The other, I guess, comment I'll make is that, and it's related, like the deal making experience in Africa should be on par with how it's being done in other parts of the world, right? There should be no daylight in the user experience, if I can use some tech terms for a second, whether from the buy side or the sell side in Africa as it is in any other part of the world. And doing the deal on a company in the UK or in Brazil or in China is a straightforward process, largely driven by digital solutions. It should not be a different experience in Africa, and I think that's what we're all looking to build, elevate that industry standard, not only to make the process a whole lot more efficient, but also really bring the deal making experience in line, if not have it exceed the global industry standard.
Thank you very much appreciated. And in fact, as Jakob said, that COVID has accelerated that this is not going to be just a new, as Rob put it, it's going to be the norm. And one of the poll question I put was that, would you invest in a startup you've never met founders in person, but due diligence and investability is done by trusted professionals? And 55% of the audience said yes. So we are in that direction. It's good. But let's also bring a story out of your platforms. So my question will be to each of you. Do you have any story you can share us that by digitizing opportunities that investment has taken place? And based on this experience, why are you optimistic about the tech investment in Africa?
Yeah, I mean, I'll sort of, go first in terms of, looking at corporates that have managed to raise capital through our platform. I've talked about the example of the transaction in Tanzania, which was a $4 million trade finance transaction. But the one that, one of the other ones that actually sort of feels a lot closer to my heart is always the transaction in Ghana, where, again, this is one of those transactions that was done end to end, pretty much digitally. So both from the origination standpoint to the due diligence to the completion and essential, disbursement of capital. None of these guys, and this particular corporate in Ghana, again, is the typical corporate that, the guys, no, he doesn't have any business in Accra, right? His farm is somewhere in, Kumasi. That's where his business is. The guys never, apart from his bank, he's never been to an investment banker to help with capital raise, comes across the platform, provides all of his documentations, gets matched to a trade finance fund through our platform. The due diligence is done, everything is completed digitally, and the guy raises capital. And this guy, and again, we've got the use case on our site, essentially is able to not only expand his business, but also hire about 150 to 200 people, right, as part of his expansion plans. So it's not just, the solutions we provide, right, are not sort of, on the tech fancy side of things alone, but this actually do have real impacts, right? These things do penetrate into various countries to create jobs and also help companies grow. And I think, you just can't talk not enough about those things and how much impact it creates.
Thank you very much. Rob?
I think from our side, I mean, what's been really interesting on the SOCO side is the rapid upcoming supply of a source of capital we wouldn't have foreseen a year ago, and that's the DFI space. Like in a time span of about 6 months, we've been engaged by just top of my mind, USAID, the US Development Finance Corporation, the UK Department for International Trade, Africa Development Bank, obviously a more known player, but also one that is ramping up, all with tremendously deep pockets of capital to put into corporate Africa in general. So not tech specific, but one would imagine quite a marginal that is going to end up in the tech space. That's a pot of capital which is obviously very welcome. Like it's adding to the commercial funds that have been allocated for a while now, but it's a welcome addition. But it's also a pot of capital that, because of their their distance from corporate Africa, and in particular from fund-seeking startups, would have had a hard time to find a home had it not been through the platform such as the one that Isoko offers, right? So I think the fact that we're being engaged and the fact that we become an integrated part in their workflow for origination and screening of deals to feed into their deal teams is just a sign of I guess the values of allocating that new capital in an efficient way, and ultimately the businesses that can benefit from it. I mean, to quote some numbers, around $900 million worth of deals fed into the DIT pipeline over the time span of 9 months. Our DFC pipeline, which has been running for 4 weeks, $18 million worth of deals fed into that pipeline, obviously in different stages of maturity, but all qualified investments, all investment ready opportunities, right? Otherwise they wouldn't make it into that pipeline, now going through different degrees of the investment cycle. And that money wasn't there 9 to 12 months ago. So I think that's terribly exciting.
Indeed. Thank you very much. Yeah, Cole.
Yeah, I'd kind of follow in Lanre's footsteps of just sharing a story that is actually very deep and close to me. There's a founder that started a company called Gifted Mom, which is now called Healthlane. It's based out of Cameroon, and it originally was a NGO that was in our accelerator when I was in Johannesburg. We worked with his business model, converted it into a for-profit business. 5 years later, he graduated from Y Combinator, and the things that we saw in him was that he was solving a really important problem, pre and postnatal maternity health care. So like he's actually saving lives by what he's doing. And we figured out a way for him to disseminate this health information, but also be able to create a really lucrative business model by going to like the Nestle's and Delans of the world and just saying, look, you don't have access to these people, but they do need baby formula. They do need this information. They do need these vitamins. So I am not giving you an opportunity to take a bigger slice of the pie. I'm increasing the pie for you. And he was able to come to that conclusion with working with myself as someone that was a mentor to him and plugging in some talent for him, some legal services to help him understand how to like structure term sheets. Then he graduates Y Combinator, and then through partnerships with us and funds, he got money from Future Hub, which is backed by Transient, the largest cell phone producer on Africa, as well as Chandaria Capital, one of the largest funds in East Africa and an industrial family. And now that business is going to accelerate, and he'll be a change agent in his community. And if he continues to grow and succeed, he will continue to save lives and improve the quality of health for people. And that is, one of, the touching stories that I've gotten to work with. And it kind of, keeps you motivated and keeps you going because you understand there is a real need for what you're doing.
Thank you very much. It's very deep conversation. We can continue discussing for hours and hours. I know there's a lot of success stories will come from your digitization of African opportunities. At the end of the day, we want investors to come to see opportunities so that they can say, I came to the continent, I saw an opportunity, and it was worth it and invested. So just within 30 seconds or so, for an investor to say, I came, I saw, and I invested. Any last word of wisdom to investors, each of you? Let me start with Lana.
Just be realistic.
Good point. Rob?
Embrace technology. make sure to use the digital solutions that are out there.
Yeah, go.
I would say to the investors coming and the investors on the continent, have a growth mindset. The people that you're investing in are lifelong learners. So do them a service and have the same approach.
Thank you very much. I don't see any question and answer, but it was a fantastic panel. I strongly encourage investors here to check out the website of Orbit Capital, Isoko, and also Parity, and what the founders and the CEOs have said. You'll see it for yourself. Hence, you'll be able to say that, yes, there are visible opportunities. Investment can be de-risked. The risk appetite can be tolerated, and adequate return can be made in Africa. So thank you very much, Nanre, Rob, and Iago. Very much appreciated. Now I think we'll be having a break, and then we have additional panels. At the end of the day, also we have Jack Dorsey's fireside chat. So stay in the platform. Thank you very much, and have a lovely day, afternoon, or evening, wherever you are.
Thanks.
Cheers, guys.